In this video, I'm going to discuss the concept of property, plant, and equipment according to GAAP. For an asset to be classified as property, plant, equipment, three requirements need to be met. The first one is that you acquired that asset for use, for internal use, and not necessarily to resell. If you have something that is to be sold, and normally we call that inventory, or in some instances that could be an investment as well. But for purposes of property, plant, equipment, it's an asset that it's acquired for internal use. The second requirement is that it be long-term in nature and hence depreciated over time. The only exception there being land, which land is considered property, plant, equipment, but the exception is that we don't depreciate land. And then finally, the asset is tangible in nature. So in other words, it has physical substance. It's not an intangible. If it's an intangible, then we have different accounting for it. Naturally, the next question is, what if I acquire this asset, what cost can I include as part of the asset? In other words, what amounts can I capitalize is the way we would say it. So the key here is this word necessary. You capitalize the costs necessary to prepare the asset for its intended use. So what are some of those items? Obviously, the purchase price of this asset, but you can also include all these other items that are necessary in the acquisition of that asset. So the taxes, shipping, installation fees, even training to get personnel started on the machine, and any asset retirement obligations that you may have. You need to capitalize the present value of that. So this is maybe at the end of the period, you have to clear up the land where the machine was at. So whatever costs are involved in doing that, then those are also capitalizable. And other items to consider here in the discussion of what costs to include or not to include in this case are discounts lost. So if you had the opportunity to take a discount in the purchase of this asset and you failed to take the discount from the vendor, we call that a discount lost, right? And in theory, that's a financing cost because it's like you borrowing money or you had an opportunity to pay this at a lesser value, but you paid more, meaning you financed part of the purchase. So in theory, it should not be capitalized. Even though some companies, capitalize those amounts just because they're many times immaterial in nature. So because of that, it's a non-issue. But just keep that in mind that, in theory, these should not be capitalized. Other things to consider are post-acquisition costs, sometimes called capital expenditures after you've acquired the asset. So you can either capitalize some of those post-acquisition costs or expense them. And the distinction really comes down to whether the life or the output of the machine or the property, plant, and equipment increases or the quality increases. So if at any time any amounts of money you put into the property, plant, and equipment, if it does improve the life or the quality of the output, then you can capitalize. But if, on the other hand, those costs that you incur simply maintain the current life or the current quality, then those would just be considered operating expenses and you would have to expense and not capitalize. In the case where you would capitalize such a cost, then that provides a new basis or a new book value for the asset, and you'll have to recompute depreciation as well. I do have a side note here that there's a video on this concept of the value of the transaction. So I mentioned here that these are the things you capitalize, okay, any necessary costs. But sometimes it can get tricky, right? Because there's many values that are stated in a transaction. So just to be clear, there's a video that discusses this idea of what value should I record for this property, plant, equipment. And if you want to see that video, that'll help you understand some of the issues that come up with value in property, plant, equipment. And for that matter, any transaction in accounting. All right, another thing that occurs that is worth mentioning with property, plant, equipment is self-constructed property plant equipment. So some accounting issues arise when we decide to make our own property plant equipment as opposed to buying it, maybe like like I was discussing here. So you need a specialized machine, you make it yourself. If you make it yourself, then the next question is, well, can I capitalize those costs of making that machine? And the answer is yes. Okay, if you construct your own fixed asset or property plant equipment for your own use, you are allowed to capitalize all costs of production. So what does that mean? This is like in cost accounting, your direct materials, your direct labor, and a reasonable amount of overhead. Now, here's a caveat that you got to be careful with. So, I mentioned that you can capitalize all costs of production, right? But the total amount that you capitalize between these items here cannot exceed the fair market value of that property plant equipment. So that's the upper threshold there. In other words, just because you made it, if you were very inefficient at making it and you incurred cost overruns, then perhaps you would not be able to capitalize all of the amount. Some of it might have to be expensed. And interestingly enough, if you are making your own asset, it takes a while to make your own asset. One of the items that you can also capitalize, which is a necessary cost, is interest during the construction period. So, interest would normally flow to overhead. So if you take out a loan, or if you have some loans, even if you just have some loans, not necessarily directly tied to the construction of this asset that you're making, but if you have some loans, you can capitalize some of that interest. Now, there are some rules, and they're pretty detailed as to what amounts you can capitalize. And I encourage you to watch this video here on interest on self-constructed property plant equipment. It has all the details as to what we are allowed or not allowed to capitalize. And then finally, another item worth mentioning here related to property plant equipment, is the idea of non-monetary exchanges of assets. So what do I mean by that? Usually when we're discussing transactions in accounting in general, but here in the topic of property plant equipment, we're assuming that there's an exchange of cash. If I'm buying a machine, I'm buying it for cash. If I'm constructing the machine, I'm spending cash to build it, right? So we don't think about that. And sometimes the valuation of those inputs is fairly straightforward in terms of the cash component. Okay. Now, there is this idea here of non-monetary. In other words, sometimes we exchange one of our assets, one of our property plant equipment, with the property plant and equipment of another party. And either no cash, hence non-monetary, either no cash exchange takes place or very little cash exchange takes place. Okay. And for those types of transactions, we have specific rules under GAAP which dictate how we should value that transaction, how we should recognize gains or losses. And again, those are somewhat detailed. So if you want to understand a little bit more about this concept, then watch the video, Property Plant Equipment, Non-Monetary Exchange of Assets. Okay, so just to quickly summarize the main point here of this video. For an asset to be called property plant equipment, you need to meet these requirements, right? Otherwise, if it does not meet these requirements, then it's probably classified as something else, as another type of asset. We mentioned maybe inventory, maybe investment, or something else. And finally, the other main point I want to drive is when you're deciding what costs need to be capitalized for the purchase of that asset, then it's necessary costs, right? You capitalize the necessary costs so that you prepare that asset for the intended use that you had initially. All right, this concludes the video introducing property plant equipment.